Hey everyone, and welcome back to the Finance Zone. Buying a stock is easy, but buying the right stock without a time-tested strategy is incredibly hard. So what are the best stocks to buy now or put on a watch list? Today, we're going to be talking about top stocks to buy now. Make sure to stay till the end to learn about these amazing stocks. Senseonics. SENS short-term technical score of 87 indicates that the stock has traded more bullishly over the last month than 87% of stocks on the market. In the Diagnostics and Research industry, which ranks 42 out of 146 industries, Senseonics Holdings Inc ranks higher than 80% of stocks. Senseonics Holdings Inc has risen 185.71% over the past month, closing at 41 cents on December 18th. During this period of time, the stock fell as low as 41 cents and high as $1.21. SENS has an average analyst recommendation of strong buy. The company has an average price target of 83 cents. Senseonics Holdings Inc has a long-term technical rank of 98. This means that trading over the last 200 trading days has placed the company in the upper half of stocks, with 2% of the market scoring higher. In the Diagnostics and Research industry, which has a number 39 of this metric, SENS ranks better than 94% of stocks. Tesla went public in 2010, offering 13.3 million shares at $17 per share. At the time of this writing, shares are trading for more than $830 per share. While that's an impressive return on investment, it's been a volatile road to this point, marked by a history of missed manufacturing deadlines, controversial comments from CEO Elon Musk, and a steady stream of reputable traders who denounce the company's valuation and recommend shorting the stock. With a market capitalization of around $800 billion, Tesla is the world's largest automaker by value, larger than Toyota Motor Corp (TM), Honda Motor Corp (HMC), and General Motor Corp (GM) combined. All of these companies took their cue from Tesla and manufacture their own electric and low-emission automobiles, but Tesla continues to be the dominant name in the U.S. market. The value the market is placing on Tesla is eye-popping. At the current stock price, the market value of its equity is $825 billion, making Tesla the sixth largest company by equity market capitalization in the Morningstar USA Market Index. At its current market cap, Tesla's equity is 8 times more value than the world's largest auto manufacturer, Volkswagen VW3, and approximately 7 times the combined equity valuation of both General Motors, GM, and Ford, F. Over the course of 2020, Tesla's equity market cap has increased by almost $600 billion, which is greater than the total equity market cap of Warren Buffett's Berkshire Hathaway, BRK.B. Tesla is the global leader in designing and manufacturing battery electric vehicles, or BEVs, as well as a pioneer in developing solar power and large storage batteries. Tesla's addressable markets have a strong tailwind from their secular shift from internal combustion engines to BEVs. One of the biggest bright spots in Tesla's most recent earnings report was a record number of both production and deliveries. In the fourth quarter, Tesla produced 179,757 vehicles, an impressive 71% increase from the same quarter last year, and well more than 145,036 vehicles Tesla built in the third quarter. As for deliveries, Tesla found 188,666 vehicles a brand new home, a 61% year-over-year increase. Tesla had set an ambitious goal of 500,000 vehicles delivered by the end of the year. Even with pandemic-related disruptions on its production lines, the company came incredibly close, delivering 499,647 over the course of 2020. The management team at Tesla believes that it can improve on that, promising 50% average annual growth in deliveries over the coming years. Looking over the long term, bullish investors place their hopes on fully autonomous vehicles. Dozens of companies are working toward that end in one way or another, but Tesla's lead is difficult to surmount. Tesla's use of cameras, radar, and GPS have been advancing for years to the point that Tesla vehicles are practically self-driving. This opens the door for other avenues of growth as well. During the earnings call, Musk discussed self-driving Teslas being used as robo-taxis. From anyone else, that'd be a fantastic futuristic idea. For Musk and Tesla, it's a distinct possibility. Finally, with President Joe Biden's November victory combined with Democratic control of Congress, comes bigger opportunities for Tesla. Companies that focus on green and emission-free technologies will reap the rewards of tax credits for consumers and manufacturers alike. While those rewards have yet to manifest themselves, President Biden's ambitious plan to combat climate change points toward plenty of future opportunities for Tesla. Palantir Technologies. Palantir, NYSE PLTR, stock price has nearly quadrupled since its direct listing last September. The data mining firm attracted a stampede of bulls after it posted a strong third-quarter earnings report last November, hiked its full-year revenue guidance, and signed new government and enterprise contracts. But Palantir's meteoric rise has also raised red flags. At $36 a share, the stock trades at nearly 50 times next year's sales, making it one of the market's priciest tech stocks. Its lockup period will also expire after its upcoming fourth-quarter earnings report, and a lot of insiders could be eager to cash out. Palantir still isn't profitable, and some of its U.S. government contracts, especially one with Immigration and Customs Enforcement, ICE, to track undocumented immigrants, are controversial. But despite all of these fears, we believe Palantir remains a compelling investment for 3 simple reasons. 1. Sticky government contracts. In its prospectus, Palantir claims it will become the default operating system for data across the U.S. government. Its Gotham platform, which mainly serves government clients, already helps the U.S. military, FBI, CIA, and other government agencies make data-driven decisions. Palantir's revenue from government customers rose 73% year over year to $420.3 million, or 55% of its top line, in the first 9 months of 2020. During the third quarter, it secured a new AI contract with the U.S. Army. Last December, the U.S. Army renewed the second year of a 4-year analytics partnership, which provided for 1 base year and 3 optional years with Palantir. That same month, the Food and Drug Administration, FDA, which already uses some of Gotham's tools, awarded Palantir a new 3-year contract to mark the development of new drugs. In January, the U.S. Army hired Palantir to modernize its ground stations. This contract, which will start with a prototype and expand over 4 phases, could be worth up to $250 million. These contracts all indicate Gotham is sticky and will allow Palantir to deploy additional services to boost its average revenue per customer and widen its moat against its potential challengers. 2. Growth potential in the enterprise market. Palantir also helps enterprise customers process data with its Foundry platform. The Wall Street bears often claim Foundry faces too much competition in the enterprise analytics market, but Palantir's enterprise revenues still rose 30% year over year to $320.3 million, or 45% of its top line, in the first 9 months of 2020. During the third quarter, Foundry signed a new contract with the National Institute of Health, renewed a contract with a big aerospace customer, and pulled a, quote, major consumer goods company away from an unnamed rival. Last December, it signed a new 2-year Foundry contract with the UK National Health Service, NHS, to track COVID-19 infections. Throughout January and February, it expanded its Foundry deals with Fujitsu and BP, NYSE BP, while signing new contracts with PG&E, PCG, Rio Tinto, Rio, and IBM. These ideals indicate Foundry's tools can be applied to a wide range of industries, including energy management services for PG&E and BP, optimizing mining operations for Rio Tinto, or optimizing AI tools for IBM, and will likely keep growing after Gotham's growth slows down. Third, it's a great artificial intelligence play. The global AI market could still grow at a compound annual growth rate of 42.2% between 2020 and 2027, according to Grandview Research, as AI tools are increasingly used to process data across a wide range of industries. That secular trend will light a fire under companies like Palantir that process large amounts of data into actionable strategies. Those tailwinds could help Palantir generate high double-digit sales growth over the next decade and help its stocks grow into premium valuation. Keep your eye on its long-term goals. Palantir stock could dip over the next few months as investors take some profits amid concerns about its high valuation and lockup expiration. However, those declines could be great opportunities for long-term investors who are willing to tune out the noise over a few years. Apple stock. In its most recent quarter, which ended on December 26, the tech giant racked up record quarterly sales of more than $100 billion for the first time as iPhone demand rebounded, and all of the company's other sale categories also churned out revenue increases well into the double digits. The holiday quarter got a boost from Apple's launch of its 5G iPhone 12 models, which helped lift revenue in the company's biggest sales category by 17% year over year. That followed the previous quarter iPhone sales slump as people waited for the new models to be released. Meanwhile, Mac sales rose 21% year over year, iPad revenue was up 41%, and the wearables, home, and accessories category, which includes the Apple Watch, saw a 30% jump in sales. Apple's high-margin services business grew by 24%. All that sales growth helped the company beat Wall Street estimates on its top-bottom lines, with total revenue topping $111 billion and earnings per share (EPS) clocking at $1.68. EPS grew by 35% year over year in its fiscal 2021 first quarter, which is astonishing for a company of its size. The numbers show how Apple has continued to benefit from the demand of electronics as people work, learn, shop, and entertain themselves remotely during the pandemic. Apple's position within the so-called stay-at-home trade, coupled with its status as a stable company with a massive cash pile, has helped Apple's shares hit record highs as investors have looked for relatively safe amid the pandemic. That said, the stock isn't cheap. The company Ford's price-earnings ratio currently stands at more than 35. That lofty valuation might keep some investors at bay, but Apple could also be a tempting stock based on current performance and promising longer-term potential. In the short term, Apple's shares may continue to benefit from the stay-at-home trade as questions arise about the speed of the vaccine rollout, if the economy will be subject to double-dip recession, and whether President Joe Biden's planned stimulus might get watered down. Thanks for watching. While you're here, go ahead and click one of the 2 videos on your screen, and don't forget to like, subscribe, and comment below. See you there, and thanks for watching.